First of all, I just want to talk about the idea that as we look to the future, that we are on the cusp of a change or in the midst of a change. And in this industry, I think we have heard this before. And so one of the things I think we can sort of pose the question on is, what is different right now that means that we are getting closer to a bigger adoption, dare I say mass adoption, when it comes to tokens? And again, I'm going to start on the end and start with Dan and put Dan on the spot here.
Well, I'm not sure that I'm someone to listen to. I famously said in 2020, this is the year of tokenization and security tokens. So I was off by just a little. Of course, there are security tokens. But the issue for the markets is, for capital markets, is you can't just have part of the capital market stack. So if you just have one component and you depend on traditional components, you're just another system in an already complex financial services ecosystem. So what you've seen is you actually have to have each of the parts, from the front end, broker facing, the liquidity functions, the issuance functions, banking back office and middle office functions, and custody functions. All of those must be present. Well, here's the good news. You've actually seen those firms, many of them presented here today. And so there's considerable maturity that wasn't here even as recently as 2020. Now, in our world, of course, with our institutional partners, they are quite active in this space. You'll see WisdomTree launching WisdomTree Prime here in likely about a month, and certainly going much more mainstream with it by the end of the year. This is bringing positions. WisdomTree, of course, is in the asset management space, allowing asset managers to go direct to customers without the need for intermediaries through the benefits of tokenization, among other things.
All right, who else wants to chime in on this? Anthony, you look like you're chomping at the bit here.
I can do. So why is it different this time? Suggests that something didn't happen when it should have done, right? And I think with what I would call digital securities, it's really had two full storms, and they happened at exactly the same time. And I think it's important to have a little bit of bigger picture and historical context on this. So I was working for one of the biggest derivatives houses in the world when I got interested in this space in 2014. And it was 2015, Ethereum, I think, launched then. And there was this divergence between the existing world of crypto innovating in the crypto space, and then financial institutions trying to take this technology and repurpose it to rewire a lot of their spaghetti. And in the crypto world, you had security tokens trying to do digitized securities, but from a crypto perspective, not properly understanding financial services. And you had financial services trying to rewire all their legacy, but not actually taking a really transformative, innovative approach with the technology. And I think the reason it's different this time is because these two worlds have converged. And for security tokens, digital securities to take off, it needs the tech of crypto, no preconceptions about how this world works. You know, we want 24/7, instant settlement, instant exchange of value. And it needs institutional engaged in this world with appropriate regulation, with an understanding of how all of this works. And I think Ownera, we approached this, and the vision of Ownera was around taking the best tech from crypto, but institutional engagement and global distribution. And with those two things, global distribution, institutional engagement, you'll get great assets, and you'll have pools of investors who can access those assets who don't need to know how crypto works, right? That makes it accessible to everybody.
And yeah, really quickly, and I would just add to that, that the client requirements are also changing. And so when you look at the heritage traditional space, you know, that market's roughly $450 trillion. And you compare that with crypto or digital assets, and you know, you're talking about 2 trillion, give or take, right on any given day. And so it's just a very small percentage of the overall pie. But when we kind of open that hood and look at the growth rates of the digital asset business, and even at a place like Northern Trust, you know, we're only providing services on about 500 million of digital assets, but the growth of that business is 50x year over year. And the margins from a revenue perspective, right, are significantly larger than the traditional world. And so that says to us that the client requirement, right, is becoming more clear, and institutional investors.
But Patrick, if I may, how much of that is in tokens as opposed to straight up cryptocurrencies?
Yeah, I mean, it's a really great question, Julie. So all of that is crypto assets. And I think when you look at, again, kind of the stack of clients, you see it start very much in the retail space, right? But it then starts to transition in, on that kind of that spectrum into the alt world. And so we've seen the hedge funds, the alternative managers, private equity firms start to, really dabble in this space, and so we've seen it there. The next evolution of that is true institutional participants, so the large sovereign wealth funds, pension funds, insurance general accounts, et cetera. So.
Yeah, and I think that, kind of Northern Trust should be applauded for that. I think, we can look at that and someone says that's not a big number. I think that's a big number, and I think it's really important for the industry, and I think it's a really important step. We have conversations with the majority of the folks on Wall Street, and one of the largest investment banks said to us just the other day that they're not going to touch anything unless it's registered or rated, period. That's it, bar none. So, there are some really, really, really significant issues in the marketplace right now that I think are deterring market participants from getting comfortable with digital assets and digital asset securities. Now, I think it's clear that digital asset securities are going to be the path that a lot of the folks in traditional finance gravitate to first. But there are some significant issues that we need to solve for, right? And those two issues in my mind are AML, KYC, and custody. And those are the 2 points of risk for large-scale financial institutions. And if we as an institution, we as a community don't have answers that are acceptable, it's going to further delay the adoption of things like digital asset securities for sure.
And Biz, now that you've confirmed that you're at Citi, maybe you can give us the perspective from you all as well, from another institutional perspective here.
I think from, our perspective, we can separate the space between what's happening on the assets and the returns that the assets are providing versus the inherent efficiencies that the underlying technology provides. I think Anthony touched on it briefly. The traditional financial products, where kind of unique, innovative risk processes, if you look at derivatives and credit derivatives, but they were getting jammed through legacy infrastructure that was designed for securities. And so you really ended up creating a lot of patchwork. And so I think where tokens have got to, and whether, irrespective of what digital assets you're talking about, we are now looking at the underlying blockchain and DLT technology and saying it can handle scale. It can handle millions of participants trying to exchange and settle trades with each other. And I think that's why I think you're starting to get to that, I think, momentum where you've tried various use cases, tried them on a blockchain distributed ledger, and it works. So it's very easy for now more traditional and large-scale, institutions, whether on the buy side or the sell side, to say, well, this thing's worked. It's been proved through many different use cases. And so therefore this is here to stay. And so I think that's why the momentum is picking up all of a sudden now.
And are you getting more and more clients asking about this? Is it, in other words, is it coming from the clients or is it push or pull?
I think the clients are trying to explore the space. Obviously, Jerald mentioned about the regulatory landscape, and more than regulatory landscape, I think everyone in the marketplace, that is managing money on behalf of other people has a fiduciary responsibility. So they're also trying to figure out the appropriateness, whether the risk management is mature enough, whether AML KYC is mature enough. And so I think whether it's looking at the return profile, whether it's looking at a diversification profile, a lot of people have said this is a nice diversification alternative to owning gold. I think the interest is there. People have realized that the technology is starting to mature. Dan mentioned about custody and other stuff. So it's almost like every piece of a financial asset investing lifestyle is starting to get checked off. And so that is really causing the interest coming from our clients.
Now, I think we can have this discussion with sort of acknowledging also what's going on out in the world right now, right? We're sitting here in this fancy ballroom with the chandelier, and you guys have all paid your fees to be here. And there's carnage out there, right? I mean, I talk about this every day on my show. The market is selling off, whether we're talking about stocks or crypto. It seems like we're starting to see some tightening in the private markets as well, although they were later to tighten up. I guess Anthony can tell us that the private markets are still open to some degree. But, we are seeing things start to change, and sentiment is certainly starting to change. So I think we have to talk about that as well as to how that's going to affect things, right? Are we going to see further delay in the developments of some of this? Are we going to see less appetite for investment and risk-taking in newer products and newer technologies as a result of what's happening in the world. So, Anthony, it looks like you want to dive into this again. Go for it.
I think where we are right now, it's actually going to accelerate the space we're in. So we're entering a high inflation, or we've entered a high inflation environment. I remember the last one. If you're under 40, you don't know what any of this means, right? But we're entering a higher inflation environment. We are dealing with investors want access to alternative assets. They want inflation hedges, such as real estate. They want to come out of the public markets. They want access to make investment in high growth companies. So I think from the point of view of, is this the right time? Actually, this is exactly the right time, right? If the public capital markets were booming, and will boom for the next 2 years, it might actually be harder for us. So I think the carnage is actually putting us in a position where we think we're well positioned for what investors are looking for at a global level as we try and navigate the next few years.
I mean, Julie, our view is that the carnage that's out there creates a really great case for digital asset securities, right? So what are some of the big issues that digital asset securities have that differentiate themselves from different tokens that are out there, right? So there are things and there are safety mechanisms that can be put in place when you construct a digital asset security, right? Some of the different issuers at different protocols, Securitize, for example, has the DS protocol. Vertalo's got their own protocol. Tokeny's got their own protocol. Security's got their own protocol. And these protocols will allow for some protections for investors. So I'll give you an example. So what's the biggest, I talked about custody a second ago, and I said that's one of the biggest concerns that large-scale financial institutions have. Well, the concern is that all of a sudden, you know, the security guy or the custody, the guy in custody drops his ledger in the river, and all of a sudden, you know, all the assets of the bank are gone. Well, if it's Bitcoin, if it's Ethereum, that's a real risk, right? It's something that has to be combated, and it's something that, you know, kind of folks like Northern and folks like Citi obviously take very seriously, and it's something that, you know, has to be solved for. But with digital asset securities, you can program, you know, kind of into that code, that smart contract, the ability for the transfer agent to freeze, cancel, and replace and reissue these tokens after an affidavit was filed and an investigation was complete. So that means I can drop my ledger in the river, I can lose whatever billions of dollars I've got, and within a couple of days, provided that there's no nefarious behavior that took place, I can have them reissued. Well, that's something that's really, really powerful. But it's also very much in contrast to digital assets, right, or cryptocurrencies that were created for other reasons. So I think some of these safety measures and protocols that we've been talking about, not publicly, once implemented, will provide a level of comfort for financial institutions to custody and offer to their clients digital assets and digital asset security specifically.
And yeah, if I can take that up too, I think, back to the point, I agree with the sentiment that right now is ripe, I think, for an acceleration in innovation. And if you look at what's happened in the stablecoin network right over the last, call it 14 days, I think it screams, you know, a demand for large institutional players, or at least institutions that can provide a high level of safety and security of your assets. And so all of our firms up here are working, I think, very intently to create an ecosystem and an environment where a large institutional participant feels comfortable knowing that someone like a Northern Trust has vetted a particular protocol or vetted an ecosystem or a stablecoin network and is able to provide a level of comfort to engage in that. We are actively building that. That future's here. And so I think that again, you know, accelerates the adoption.
I completely agree, Patrick. And to JD's point, I think almost everyone here in the room would actually agree with the position that this is why these should be regulated assets. And this is sort of the purpose of a security token summit, is the assets that were involved last week, in case you aren't tracking, there was a cascade of events that created a liquidity challenge and a series of encumbrances that ultimately caused the market to dip substantially. That same thing happened in 2008 at a greater scale, so it's not like financial markets aren't immune to these things. But this is why you regulate the markets and why you have, where you need to understand encumbrance. But as JD said, this is actually something through smart contracts that for the first time, unlike 2008, we actually have the tools to measure these things in real time, but you have to have the proper disclosures and the proper controls. So in the wild crypto world, those controls don't exist, and you still have these runaway events. But in a securities world, automated through blockchain. We actually have the tools to prevent these things. And so we're eager to see the rest of the marketplace fall in line with these rule sets.
I mean, all this sounds great. It all sounds great, but it still feels a little bit like a disconnect. And I just wonder, when you're trying to target a particular audience, I think if you're talking to an institutional audience, and Biz and Patrick, maybe you can talk to us about this, are they convinced? And I wonder if the pitch to a retail audience, is a retail audience going to look out there and see crypto? In other words, are they, this is complicated. And so is there going to be enough understanding and differentiation that you're not just going to say, I don't want anything to do with this stuff?
I mean, I'll take a stab at it. I think when you look at, what possibly might attract or grow the market, and this is certainly a market where some of these assets have grown from the retail space, got to a point where there's enough interest trading. These assets existed 5 years ago. These tokens, no one was looking about them. No one was talking about them. And then it almost seems like you've got to a stage where the aggregate amount of liquidity that has organically built up has now started attracting interest from wholesale investment areas. But if you look at some of the ways in which you got people interested in the retail two-legged individuals, gamification and using of reward gamings was a big way to get people interested. Would that apply to wholesale market clients? And no, they're probably more interested in the dull, boring stuff that Jerald was referring to: AML, KYC, fiduciary responsibilities, right? There's no amount of gamification that gets you around that. So there are two different lenses on which people will look at some of these markets. But I think what we are now seeing is some of the operational processes are maturing, which is why your previous comment about, if you look at the state of the traditional markets today, there's massive volatility, right? I mean, prices move up and down based on buyers and sellers, right? And despite all that movement, yes, sometimes people stop looking at new funky assets and go back to basics. But I think it's not harmed any of the operational resiliency of the underlying DLT networks. The other aspect is, the DLT and other solutions are trying to bring efficiencies into markets. You can see settlement times shrinking, right? Now that's a big attractiveness for people that have capital in large amounts. And if I can move from settling instruments, T+2, T+1 to T+ intraday, that's adding a lot more liquidity into the market. So Julie, to answer your question, it's almost like combining your two comments to saying, yes, wholesale large institutions probably have a very different lens when they look at some of this stuff, but I think the trend is in the right direction for them. I don't know, Patrick?
Yeah, I mean, I'll add to that, that it's not just in the infrastructure, but we're seeing it in product and or funds. So Northern is now providing asset servicing, fund administration for an Invesco spot Bitcoin ETN in the UK, right? And Invesco is not, they're not backtracking, right? And I think you just have to look at all the applications for a spot Bitcoin ETF here in the US to understand that the institutional adoption is there. There's a couple of, let's call them roadblocks, right? Or speed bumps in the way, but it's not going backwards, is the point.
Yeah, and have you noticed there are two languages going on here? So if you say it's carnage out there, right, are you referring to the capital markets, what's going on with the FTSE and the S&P, or are you talking about the fact that some algorithmic stablecoin did a death spiral last week and we had volatility in crypto, right? Crypto actually is fairly small and niche, right? It's a $2 trillion market. The capital markets are 100 times bigger than that, private and public markets, right? And what the real prize here is the transformation of private markets, right? And that's where we're positioned. So we shouldn't get hung up about whether institutions are participating in crypto per se, right? It's not about that. It's about, can you take this technology and digitize all of those assets, the private markets, the largest market in the world, and that's what we're poised to do right now. That's what's happening right now, and that's what's really exciting. Not whether crypto is accessible to more people. No, actually, you want people to be able to, your average investor to be able to invest without knowing anything about this space, right? You want to give them a friendly wallet provided to them by Citi or by an institution through an app that they understand, a bit like using your online banking, and you want to be able to see all of these assets. You don't care if they're digital assets on a blockchain. You just want to be able to see your private companies alongside your real estate, alongside your existing public portfolio. You want to, manage your 501k or whatever you have over here in the US. As we say in Europe, we don't do it that way. But it's about that. So this whole conversation isn't about whether an algorithmic stablecoin wasn't implemented correctly and the crypto market's going up and down, so what, right? What this is about is carnage out there in the major capital markets, because we're in a different part of the economic cycle, and that's where things are really interesting for us now, because actually things are perfectly poised for us to be able to take the private markets online and give investors access to alternative assets, give them inflation hedges in real estate, give them access to high-growth private companies. So you see that your question was answered in different ways.
But sentiment, I think, is still an important, kind of can bleed through to all of those things. But your point is well taken.
Well, I agree with 99% of what you said. I want to challenge just one point, which is behind these institutions, right, and behind the technology and the protocols, there are real people. And when at Northern, when we think about our clients, it's the New York City cop, right, or the New York City firefighter whose pension, right, we're managing. And so you don't see a 99.98% drop in an asset in the heritage world, right? Apple does not crater and lose virtually 100% of its value. And so I do think it's really important to have safety and security, to have that trust be there, because there are real people's dollars behind kind of the whole conversation.
So, Julie, one of the panelists earlier today said that, Gary Gensler said to him that his job is to protect investors, right? And I think that's a pretty profound statement, right? It's pretty bold, but it's a real statement. It's why regulators work. It's what they do. One of the reasons why we opted to go down a regulatory path with reference to one of the products we created, which is called a BTF, a blockchain transferred fund, was specifically for that, was that the investor protections that are granted under, let's say, the 40 Act, right, are so great that it gives comfort for investors to invest in that fund or to use that product. And this particular product creates digital asset securities. It's the only fund that's out there that's a 40 Act registered product that issues these shares as digital asset securities. That model, that wrapper, we think has a lot of merit. It's got a lot of value, because now what you're doing is you're creating a token that gives the confidence not only for the investor, the one that's holding the token, but for others that have to custody it, for others that actually want to touch this within that ecosystem. And that model seems to make particular sense to us, and that's why we got involved in doing that in 2018. Right? And I think others on this stage have been involved in different initiatives, many of which aren't being spoken about. But the banks are all involved with digital asset securities behind the scene, trying to figure out how they could solve for problems like treasury management and liquidity management and all these other different elements that exist right now, whereby the benefits, right, outside the securities we're talking about, transferability and time, eliminate risk, which makes the entire ecosystem less dangerous for everybody.
So I guess then the crux of the question is, when are we going to get to Anthony's vision of you open up your app and you've got your real estate, your other assets, your Arca or other products that you guys make? I mean, Dan, you want to take this? Like, how close are we to this vision that he's talking about?
We're launching a product to do just that next month. So that's precisely working with our institutional partners, where you're able to see a range of different exposures. And at first, it's a limited range of exposures, but by the end of the year, you'll be able to see in this case, just publicly traded assets, but on our own, with our own subsidiary brokers, you'll be able to see public, private assets, crypto, commodities, cash positions, all in one. And it feels like a Robinhood app, or it feels like PayPal. It doesn't feel like MetaMask when you use it. So it's a much simpler model. It's recoverable. If there's loss of custody, there's recourse. As JD mentioned, there are things you can do about this in an advanced crypto model. So we're not far away from that. Now, it took a lot of work by many people in this room to get us up to this point. This particular case took more than 2 years of engagement with the SEC, and you have to be able to answer all of the hard questions that the regulators ask, like, What happens if an intermediary goes out of business? There is the SIPA concern, Security Investor Protection Act, where you must be able to show that you can revoke that asset and restore it to its rightful owner. Well, with bearer instruments, with Bitcoin, that's not possible, and there are great examples of this. But with advances on the blockchain ledger, you get real benefits from this model. As JD pointed out some of them, there's a great example that the Invenio team spoke to earlier, which is you can connect data to these assets and make illiquid assets now, you can increase their fungibility, increase their liquidity, and that results then in, for institutional investors, an ability to borrow against those positions much more effectively. So what Ownera has done, that's amazing work, is helped narrow the time until we get to the critical mass. So much of everything we're talking about here is the network effect. But there are some examples where people can get immediate benefit even before the network's in place. And so when an investor is looking at, I have a bunch of, an institutional investor, I've got a bunch of illiquid assets, which I can only borrow a little bit against because of the haircut, and suddenly I can borrow a lot against because of more effective data and the use of blockchain tools. That's a no-brainer. You don't need a network to make that decision, and that's coming fast.
This is happening now, right? So you've got organizations such as Securrency doing this, tokenizing. You've been hearing Accrue, you've been hearing Tokeny, etc. And the thing is, you've got dozens of organizations that are doing this, but they actually, I would say, they come in two flavors, right? There's those that have built vertically integrated stacks that they're like walled gardens, and they would say, it's all great, you come to us, we've got the assets and the investors, and it'll all be fine, and all the technology's there, and it works. You can go there, and the investors and the assets are in the same place. So there's organizations like that, and then there are organizations that are open, that understand there's a problem with distribution, and actually what we need to do is be able to open up those environments so pools of assets and investors can access other pools of assets and investors. And I can tell you the companies here like Securrency, Tokeny, Accrue, etc., all of that mindset, right? There's a massive prize out there, the size of the private markets. And for the next 10 years, we're going to have more assets, more liquidity, more investors than anybody can cope with, right? But only if we open up that distribution. If you can say, right, yeah, I've got assets on my platform, I've got pre-IPO companies here on the West Coast in California, and investors in London want to invest in them. Or we've got real estate in London, do you want to buy a slice of Mayfair, which is happening in the next few months, right? Maybe people in New York want to invest in a piece of Mayfair in London or in the Middle East, etc. But it's not going to happen through these walled gardens. It's going to happen because there are now dozens of fintechs all bought into this vision of opening up distribution. And once you've got distribution, then it takes off.
I mean, we wanted to get to the bottom of the same question you're asking, Julie, right? Which is how fast is it happening and when? So we engaged with Coalition Greenwich. We had them do a study for us, and they reached out to multiple hundreds of different financial professionals. And the responses that we got back were 77% of capital market participants believe that most security transactions will occur on blockchain within 5 to 10 years. And that's what we found out. And that was done last summer, and we're going to do it again in 6 months' time to try to see if those opinions have been contracted and if folks are actually, kind of working on different projects that have affected their own internal timelines that they projected to us.
And what's the percentage that's happening on blockchain right now?
0.
I mean,
low double digits,
I
probably
asked
0.
that a little bit facetiously, but
Rounding error, right? 0.
Again, there's the idea that all of this, is the key to unlocking all of this regulatory, or what is holding things back from getting to that? All these people think it's going to happen. They're the ones making the investment decisions, so they can make it happen in theory, and yet it's not happening yet.
But this statistic, I disagree with, because I think it will take longer, right? Because you were talking about all of the securities market, right? So I lived in public capital markets for 25 years. It's going to take longer than 5 or 10 years to solve that pile of spaghetti, because I spent most of my career building it. I know how complicated it is. All the preconceptions around the way the capital markets work, etc. So public capital markets is going to take a long time. But the way it's going to happen, I believe, is private markets are going now. They've been offline. They haven't been online. There's no preconceptions. We can take the best of all crypto tech, We can do instant transfer of value, 24/7 trading, everything else, and it's going to happen now. Public capital markets won't be fixed by rewiring them as where they stand. The way they will transform, I think, is from these infrastructures that we're now building together. Ultimately, you'll say, well, let's take the public securities now and put them on this new infrastructure that we've built. So the statistics about high percentage securities markets I think will take longer, and the private markets will be quicker.
So totally agree with both of those, and let me give you a different perspective on this same problem. I have a view, right? So it's not even about when or if, right? We know it's going to happen, and I'm very comfortable in speaking from a very old traditional heritage banking institution. And we spend a lot of time challenging ourselves, disintermediating ourselves. What is the role of a Northern Trust in this digital world, right? Is the bank just going to disappear because of all these early stage, companies, right? And I think what's interesting from our perspective, at least from a defensive perspective, is that even if, call it 3 or 5% of the total assets become digitized, we risk 100% of the assets that we currently service. A very, very small percentage jeopardizes our entire business. So from our perspective, the timing doesn't almost even matter, right? In theory, we're going to be prepared no matter what because we have to protect the franchise, our shareholders, and ultimately our customers anyway.
Biz, how do you guys think about that issue?
So, it's a very interesting debate because I think from a technology perspective, the process is in place to be able to, put a product on a chain and have it reach out to people who are in that network. Now, to Anthony's point, if you look at traditional financial markets, so equities markets, the bond markets, you have millions of investors all over the globe connected today by email and phone and other such, analog devices or, channels. Trying to get that entire market onto a digital ecosystem where they're all operating in the same network through same or similar platforms is like trying to change the wheels of a car while it's still on the highway, right? And so my personal opinion is, if you look at the nature of the asset and the function it performs today and so it's the product, the process, and almost like the wrapper which is in. So if you look at something like, if you look at ETFs, right? ETFs have been a very good way for people to get exposure to illiquid assets. It took a long time for the ETF market to mature. So I think the technology is there to have a network, be able to distribute it. It's almost like, are the participants in the market ready to use that network? And if they're already relying on an existing network for an existing risk, just transferring that into a different network is very challenging. So I kind of agree that maybe for private assets where, it's fewer transactions, but more bilateral, and, that market structure is probably very similar to what, can be done right off the bat. So you might see, to a certain extent, private markets get more adoption because it's fewer transactions, more bilateral. These things aren't turning over that many times. Public markets will probably take its own time to morph over.
And it will get traction because there's demand. Investors want access to those private assets, right? So that will drive it.
So the point that Biz is bringing up right here is really valid. And, kind of when we think about, the option, right? So let's take the exact same product and let's drive blockchain straight through the heart of it. So you've got the option to subscribe to either a traditional ETF or a blockchain transferred fund. Same portfolio that's in there. Well, one's very intuitive. You go to a screen, you push a button, and you've got it, and you've been doing that for many, many years. You could trade it on ATS, you can do whatever you want with it. This newer innovation requires that the actual subscriber or the buyer, the purchaser, has things like a digital custody wallet, right? And all these different pieces of the puzzle, which are brand new to them. So to expect that, that digital asset securities are going to be, kind of taking off in a year or 2 years' time, I think is somewhat unrealistic. We think that the answer is creating products that offer two different solutions. One is if you should so choose, you can receive your share in a digital format, and you could transfer that to anyone else who's whitelisted, and that could be used within an investment bank or a private bank, whereby they simply are allowing access for transferability between different subscribers to that fund or different subscribers that are known to the bank that protects them for AML and KYC purposes. The other thing you've got to consider here is that there are costs associated with operating these funds. And when you start talking about things like a blockchain-based fund, you've got charges that are like gas, for example, that aren't traditional in the regular markets right now. So there are a lot of costs as well that ultimately become a barrier to entry for folks that are trying to actually enter the new space. So we think that a level of education is totally necessary here, and that's why we advocate in some cases for some of the projects we work on, whereby we actually will develop digital asset securities, give them directly to a wallet, but if you don't want the digital asset security, that's cool. We'll create it, we can hold it in book entry form, and it'll be held with the transfer agent on behalf of the actual subscriber to the fund.
I think we're running short on time, but there's one last thing that we've sort of talked around, but I want to address a little more directly, and Dan, we'll start with you on this also. When we saw adoption in the crypto world, it sort of came retail to institutional, right? And then institutional became the thing that everyone was pushing for. It sounds like, just from what you guys are saying, that this is going to be the opposite, perhaps, that institutional adoption, even if it's in the private markets, wherever it may be, will happen first, and then maybe it'll move to retail. Dan, how do you see that evolution?
For the markets to be truly liquid, you have to have institutional adoption. And for there to be institutional adoption, you must have regulatory certainty and minimal or no counterparty risk associated with the models. I think we're getting to that point. There isn't, at the retail level, tremendous liquidity in the private markets, for example, and there probably won't be for some time. So you're probably right. It's an interesting observation. This probably starts from institutional out. That is, especially the private securities market. I think we'd probably all agree on that. What you see at the institutional level, and we haven't spoken much about this, is the opportunity using blockchain to automate the back office and middle office functions of banks and trusts. And there's a real play there, whether or not other banks participate in the model. So just to give you an example, the act of mortgages are issued by one bank and then oftentimes warehoused, purchased by a party in the warehouse, posted as collateral, used for securities lending in other scenarios. The process of winding that, when you make your mortgage payment, for those dollars to find their way to the rightful owner is an enormously complex back office function. It takes 30 days in order to do, and it's pretty inefficient for the rightful owner of those dollars and expensive for the banks to do. Blockchain can completely automate these processes using very simple structures that already exist in the DeFi space. And so you see pressure for securities lending, for collateral, et cetera, to use these blockchain tools. That's going to drive, I think, early institutional adoption from our perspective.
Yeah, and I agree with that, and I think that those tools that should be used should be digital asset securities within the banking infrastructure to solve for all these large problems, including settlement, and for the reasons I mentioned earlier, to mitigate risk within the system.
My view, Julie, is that if you plot the rate of adoption and the growth, it's almost like a step function. A little bit of what Dan was saying, it takes a lot to get large wholesale institution and the network participants up to a new kind of operating level. But once you get there, all you need is a handful of institutions because they bring a lot of scale. So you suddenly see a lot of effort, probably no results for a few years, and then you suddenly see a boom, right? And I think that's what you'll probably see in this next phase of growth as more institutions start getting involved in the space.
And I think it's important to remember that growth is exponential, right? So it happens much faster than I think we even realize. But the last thing I would leave, I think, the group with is that DLT, blockchain technology, opens up new, sectors and new markets that banks or financial institutions didn't historically participate in. And so the one I like to use is around sustainability and ESG. And that is an important conversation for every single corporate, let's say globally, but here in the US. And so we're thinking a lot around how can we leverage DLT technology to solve climate, and things like that don't currently exist, I think also drive institutional adoption in ways that we hadn't quite foreseen originally.
Yeah, I think the demand here is to get accredited and institutional investors electronic, fast access to the global private markets, and that's going to be served by, to Biz's point, you get a network effect. You only need a small number of financial institutions, each holding large pools of assets and investors, to be able to connect to one another to start to service that need. So yeah, I think that's how it will start and is starting.
All right, gentlemen, thanks so much. And up next, there's a panel on regulation to speak to all of these points. So Dan, JD, Biz, Patrick, Anthony, thanks so much.